Welcome to the Lend Academy podcast, episode number 248. This is your host, Peter Renton, founder of Lend Academy and co-founder of Lend It Fintech. Today's episode is sponsored by Lend It Fintech Digital, the new online community for financial services innovators. Today's challenges are extraordinary, with the upheaval affecting all areas of finance. More than ever before, we need to come together as an industry to learn from each other and make sense of this new world. Join Lend It Fintech Digital to connect and learn all year long from your peers and from the fintech experts. Sign up today at digital.lendit.com. Today on the show, I'm delighted to welcome back John Barlow. He is the CEO and founder of Finitive. Now, many people would know him as the CEO and founder of Eaglewood Capital, a company he sold several years ago. They were a real pioneer in the online lending space. But his new venture, or it's not that new anymore, it's a couple of 2.5 years old, but his new venture is all about connecting institutional investors, of which he was one, obviously, with non-bank lenders. And so he's done this. He's the first one to bring a sophisticated intermediary tech-enabled platform to make it much easier for platforms to raise money and make it much easier for institutional investors to deploy capital. And we go into some detail about how all this works. And we talk about the impact of COVID-19 on his operations and on the non-bank lending sector in general. He talks about the scale they're at and gives his thoughts on what the future might hold for the non-bank lending sector. It was a fascinating interview. Hope you enjoy the show. Welcome back to the podcast, John.
Thanks, Peter. It's always great to speak with you.
Likewise. So, it's been quite a few years since we last chatted here on the podcast, and so you were still at Eaglewood at that stage. So maybe you can just give the listeners a little bit of an update about what you've been doing since you left Eaglewood.
Sure. So I sold Eaglewood in the summer of 2015, and after exiting, I was an angel investor and was mostly providing early stage capital back into the fintech sector. I ended up joining 8 fintech boards, and all of the companies were either lending companies or technology providers to lending companies. And a majority of the work that I did during that time centered around helping these companies build and improve their capital markets programs. I really enjoyed the time, actually. I found it's a lot easier to tell other people, how to run their business than it is to actually run a business. Mm-hmm. So I had a great time doing that, but eventually I got a little bored watching the game from the sidelines, and so I decided to start my new company, Finitive.
Okay, so what was sort of the impetus there? I mean, apart from being bored, what were you really trying to accomplish?
Just given my background, I'm very well acquainted with the pain points and challenges that institutional investors and non-bank lenders alike face when closing credit facilities, institutional credit transactions. And I just saw a systematic need for yield from the investment community and a systematic need for capital from the non-bank lending community. And yet both sides were complaining that they weren't getting enough transactions done. And the problem, in my view, is really transaction costs. Mm-hmm. It's expensive closing transactions in this sector, certainly in terms of money, but even more so when you consider the time involved. And I think time is actually the biggest transaction cost. These non-bank lenders and the investors who fund them have been and are spending hundreds or even thousands of man hours from start to finish closing a single transaction. Mm-hmm. And I just don't think it should take that long. So I started Finitive to solve this problem.
Okay, then why don't you take us through how your platform works exactly and how you've been able to sort of take some of the time and costs out of these still complex transactions?
Sure. So our goal is to make institutional credit transactions fast and easy, similar to what the online lenders that you've covered for many years have done for mm-hmm. consumers and small businesses over the past decade. I think the same can happen in a B2B or an institutional context. And so we've built a marketplace, Finitive, for institutional credit facilities in the non-bank lending sector. And our platform is free for investors. All of the investors are on our platform are institutional. You have to have at least 50 million of assets under management to get onto the platform. Most of the investors are credit funds, banks, insurance companies, and we've got a number of other investor types as well. And through the platform, these investors can access highly vetted data rooms provided by originators who are our clients. So we are hired by originators, not by investors. And we've got teams of people who vet and diligence each of these transactions from what we call a buy-side perspective. So we got teams of people who used to be institutional investors, used to be, as they say, on the buy side, and they build models, they build data rooms, they write investment committee memos, typically 50 to 100 pages in length, and replicate what institutional investors are doing internally. And all of that information is easily accessed and downloadable in a very rapid manner by the institutional investor community. So our investors save a tremendous amount of time finding opportunities and then gathering the data that they need to perform due diligence on those opportunities. And so we tell a lot of our non-bank lending prospective clients that by the time an investor starts talking to them, they will already be fairly well advanced through the due diligence process. And so it saves both sides a tremendous amount of time. Mm-hmm. There's some similarities between our platform and a crowdfunding platform in terms of how the mechanics and the technology of the platform work, but we obviously serve a completely different audience than a crowdfunding platform. Mm-hmm. Institutional investors on one side and non-bank lending and credit transactions on the other side.
Right.
But in terms of functionality, there are a lot of similarities.
Yep. Yeah. So then, you made a name for yourself, obviously, in the online lending space, working with the likes of Lending Club, Prosper, and others. Are those the types of platforms you're working with, or I presume you're casting a broader net when it comes to originators and just the online consumer lending platforms that you worked with before?
Sure. So I've believed for many years now that there is a big opportunity in what I call non-bank lending. And online lending is a component, it's an important component of the non-bank lending theme, but it's not the only component, nor is it even a majority. There are literally thousands of non-bank lenders around the world who need to access capital. And some of the most visible lending platforms, and I won't name names, but names that are in the press often, names that emanate from Silicon Valley or from Wall Street, those are not necessarily our best clients. We get a lot of clients who are more off the beaten path. They have excellent credit. They represent excellent credit investment potential, but they're not terribly visible to Wall Street or Silicon Valley. And there are literally thousands of these, and they're in places like Kansas City, Missouri, and Tampa, Florida, and Detroit, Michigan, and Toronto, Canada, et cetera. And so a lot of our clients are, fairly well established, but less visible specialty finance companies. Some are tech-enabled, some are not, but they're around the world, and they span a number of different asset classes.
Mm-hmm. Mm-hmm. Okay, so then let's talk about these originators. I mean, it's not like you have 100 competitors doing the exact same thing as you, which I imagine it's a binary choice in a lot of ways. They either use you or they do it themselves. So why do the platforms, why would they rather work with you than just run the process themselves?
Yeah, that's a great question. every non-bank lender has a different story, and they come to us for different reasons. Some simply want far more capital than they currently have available to them, and we hear this often. We hear management teams talk about how they see just an amazing number of lending opportunities that they cannot capitalize on for lack of capital. So that's one reason. Others want to lower their cost of capital. They may have a capital provider in place, but they'd like to lower their borrowing cost or lower their interest rate. Others want more flexible terms. So we have seen lenders, non-bank lenders who have a capital provider in place. It may even be a low-cost capital provider, but that capital provider may not allow them to do everything that they want to do. In many cases, this relates to loan size. So there are often restrictions around the size of loans that you can originate. We also see restrictions around credit quality and also the types of collateral that a capital provider will allow the non-bank lender to post for their credit facility. So every story is different, but whatever the need is, a non-bank lender can typically benefit from tapping into a network that is far larger than their own network. Mm-hmm. And that's what Finitive allows them to do. Currently, we have a little over 500 institutional investors formally signed up on the platform. We have several thousand, actually north of 30,000 institutional investors in our CRM system, and several thousand that we have regular communications or dialogue with who may not necessarily be signed up on the platform yet. And so a non-bank lender can instantly, securely, confidentially get in front of a very large universe of investors who specialize in these types of transactions. And typically, when you increase your exposure, the probabilities are you'll get more term sheets, and it means more financing options. And I go back to that list of you want more capital, you want more flexible capital, you want cheaper capital, but the more capital sources you can connect with quickly, the more likely it is that your capital needs will be satisfied.
Mm-hmm. Mm-hmm. Yeah, that makes sense. So is what you're doing, is it all debt? Are there any kind of, obviously some of these deals sometimes have equity kickers. I mean, is it pretty much all debt that you're doing?
The majority of our transactions are all debt. We have had a couple of transactions that had debt plus warrants. We are approached frequently by non-bank lenders to help them raise equity capital. And so far, we've primarily referred those groups to some other partners that we have who specialize in raising equity capital.
Mm-hmm. Mm-hmm. Okay, that makes sense. So then what's the sweet spot for these deals? Are you talking like, 50 million, 100 million, 200 million? What are you sort of, what are the sizes of the deals that you're interested in?
Sure. Most of our transactions start at 50 million and it works up from there. We've had a couple of transactions in the $500 million to $1 billion range. And those have been fun to work on and exciting to see close. For smaller deals, we also have a program that we call our referral program. So we do have some investors, generally smaller funds, smaller banks, who are interested in looking at smaller transactions off platform. So we've got a number of referral partners that we send smaller deals to. If we see a good transaction, we want to be helpful however we can, and even if we don't sponsor it directly on our platform, we'll try to make a non-bank lender some sort of an introduction that could be helpful to them.
Right. Okay.
But in terms of deal size, I think our average deal size is probably in the $100 to $150 million range.
Right.
But we've sponsored deals smaller than that. We've sponsored deals larger than that. So it's a fairly large range.
Right. Okay. Okay. So, we're recording this on May 12th, and so we're about 2 months into this economic dislocation caused by the coronavirus. And I'm curious about the impact on your business and deal flow specifically. I mean, have you seen in recent weeks, has there been a dramatic decrease in the amount of deals that are getting done or that are even trying to get done?
Sure. We've certainly seen a number of investors pull back on their activity. There's no question about that. Investors are taking longer to perform due diligence. Some investors are changing deal terms that may have been agreed to pre-COVID. So we've seen some term sheets that were agreed to pre-crisis, renegotiated with higher interest rates. And there again, there's a pretty wide range that we're seeing. But generally speaking, if you look at a credit facility that was negotiated pre-COVID, if I had to guess an average, I'd say we see about a 40 to 50% wider spread than we saw pre-COVID. So, for example, if someone had a LIBOR plus 200 credit facility negotiated 10 weeks ago, that's probably a LIBOR plus 300 credit facility in today's environment. Mm-hmm. I know I'm generalizing, but if I had to guess a number, it's 40 to 50% widening of spreads. Mm-hmm. So spreads have widened, investors have slowed down, but they haven't stopped, and I think that's where this is very different from the last financial crisis. We've actually continued to see new term sheets post-COVID presented to originators. And in fact, we haven't announced this yet, but last week we actually closed a fairly sizable deal and hope to announce that shortly. And this is a deal where the client came to us in the middle of March. They engaged us, and literally within 6 weeks we had a multi-$100 million credit facility lined up, and it just closed last week. So we are seeing activity. We're seeing our user base grow on both sides of the platform. So we've had almost no interruption in terms of non-bank lenders and on the other side, investors signing up on our site. It's been fairly steady there. On the non-bank lender side, an interesting trend we've seen in the last 8 weeks is we've seen a higher percentage of large, well-capitalized non-bank lenders coming to our platform than we've ever seen in our history. And we were founded about two and a half years ago. But we are seeing a number of very high-quality groups coming to us, searching for capital, and so even larger established companies are having some struggles in this environment. Mm-hmm. And companies that perhaps 8, 10, 12 weeks ago would have raised capital on their own. That's been a very interesting trend that we've observed.
Right. And then what about across asset classes? Are you seeing certain asset classes being stronger than others, and investors more willing to put in to certain asset classes than others? I mean, how is that changing?
Sure. So it's a great question. I think pre-COVID, you had a number of credit funds and other groups that traditionally focused on distressed credit opportunities who really had nothing to do. There was very little distress in credit for many years. Mm-hmm. And a number of those pockets of capital had to reposition themselves in order to stay in business. And so a lot of those groups were funding new originations, whether that was through whole loan sale programs or credit facilities to online lenders or non-bank lenders. In one way or another, they were providing new capital to the sector. And that segment of the investor base has really repositioned back towards their core, which is providing funding to distressed companies, which comes at a significant premium, to where those companies may have borrowed prior to the downturn, and also purchasing secondary portfolios and other distressed assets. So I think distress and secondary sales are a big theme. Another theme that we're observing, this may not come as a surprise, is just a focus on highly secured opportunities with a major focus on return of principal and safety of principal. So those are some of the themes we've seen. There's a big move. If you look at the banks on our platform, the banks are really focused on well-capitalized borrowers. I think a lot of the marginal companies, and unfortunately, and I don't say this in any way of rejoicing, but unfortunately, I think a lot of startups are just getting rationalized and won't have access to credit for some time to come. So there's a big focus on the bank community on high quality, well-capitalized borrowers. We are also seeing certain asset classes, and I'll give you one or two examples, but there are certain asset classes that have incredibly short duration, very short maturities, and those asset classes are seeing a lot more interest from the investment community because the legacy problem pre-COVID assets have been cleaned out of their portfolios. And as an example, we have one group that we have worked with in the buy here, pay later space. They also call it buy now, pay later. These are 30, 45, 60-day loans that are originated through online merchants to consumers. And at this point, the majority of those loan portfolios have been originated with tighter underwriting standards post-COVID. Mm-hmm. Higher FICO scores, better debt to incomes, whatever the metric that you're focused on as it relates to credit quality. The credit quality has improved dramatically. And so, we are seeing some transactions in asset classes where, an originator truly has a portfolio that is entirely underwritten post-COVID, and those are seeing some success.
Okay, that's good to hear. Good to hear that there's there are deals getting done, and that there's still some bright spots. But I'd like to get, maybe you can. Clearly there's going to be a shakeout in the non-bank lending sector, and you've got obviously a pretty good window onto that sector now. Do you see many of these originators just not making it? How do you feel? Obviously you've done your due diligence on many of these, but how do you feel about the non-bank lending sector and the impacts that this crisis is going to have over the long term?
Yeah, that's a great question. And it's unfortunate that we're having these conversations right now. And unfortunately, I do think a number of non-bank lenders will close their doors. We've seen many groups that we speak with completely shut down their originations in recent weeks. A few have started back up. Others are still on hold. And, there's potentially a chain reaction of defaults that may be difficult to stop at this point. And I caveat that again by saying I hope I'm wrong, but you have a number of borrowers, whether those are consumers, whether those are businesses, whether those are real estate owners, whether those are auto owners or students. A number of borrowers have stopped paying their debts. I don't think this has all happened so suddenly. I don't think we've had a chance yet to fully synthesize and process and quantify the impact of this crisis on credit. But certainly delinquencies are going to go way up. That means that a number of non-bank lenders will in turn have difficulty paying their loans to their institutional investors, and thus this chain reaction unfolds and creates a lot of economic and personal and other types of damage. So I think the government has reacted as quickly and as aggressively as they've been able to, given the circumstances. But this chain reaction can be very difficult to stop once it's set in motion. And so I am hopeful that I'm wrong, but certainly we are preparing our business for what I would call an L-shaped economic recovery as opposed to a V-shaped economic recovery. And so we will see a lot of consolidation in the non-bank lending sector, and there will be a transition of asset ownership from well-capitalized groups, from poorly capitalized groups to well-capitalized groups. And,
right.
And it's just a natural part of the credit cycle, and it's unfolding as we speak.
Yeah, it is indeed. Okay, well, switching gears a little bit, maybe can you give us some sense? You said you've been in business 2.5 years, but what kind of scale you're at today? Can you give us some sense of, maybe total number of deals, amount of capital raised?
Sure. We have raised north of $2 billion of committed capital across our clients. We've had roughly 15 clients, and that number is growing pretty rapidly. We actually have more clients today in our pipeline than we've ever had in our history. But we've raised over $2 billion across, call it a dozen plus clients over the past 2 years, and looking to expand those numbers pretty significantly over the next year or two.
Mm-hmm. Okay, so then what about your own capital needs? I mean, to operate your company, have you gone out and raised money for Finitive?
We did. So a little over a year ago, we raised close to $6 million in a seed round. So we actually self-funded for the first year or so of our history, self-funded and funded with revenue. We were revenue positive from day one. But last year, we did raise a round of venture capital from Atomic Labs. I've known the founder of Atomic Labs, Jack Abraham, for many years. He was an investor in my first company, and we've really enjoyed the relationship with Atomic. And then last fall, we raised a round of venture debt from Silicon Valley Bank, and that was a $2 million credit line. And they've been fantastic partners as well. Mm-hmm. It is possible that we will go out at some point in the future and raise additional venture capital. But for now, that's what we've put in place.
Right. Okay, we're running out of time, but a couple more things I really want to get to. And one is when you look at these non-bank originators, and you said some of them are tech-enabled, some of them are not really. I mean, what should they do to improve? I'm thinking operationally. What can they do to improve operationally that will increase their chances of obtaining funding?
Yeah, that's a great question. One thing that we recommend to all of our non-bank lending clients as soon as we hire them is that they have a field exam performed. And a field exam is sometimes described as a forensic audit. And you can get a field examiner who will come, they'll often visit your office. That's a little difficult these days, but they will perform a review of all of your processes, your procedures, your risk management, your corporate governance, your adherence to your written underwriting standards, and the list goes on and on. And I would recommend, even if you don't have an institutional transaction that you're contemplating in the near future, I'd recommend getting a field examiner into your office, to inspect your operations, inspect your internal controls, et cetera, and advise you on what changes you can make today so that when you're ready for institutional capital, you can pass an inspection of that sort. I would say 95% plus of our investors will require a field exam. And if you're not ready today to pass the field exam, you won't be able to change your operations overnight. It can take weeks, if not months, to make the changes required to pass one of those inspections. And so that's probably the best advice I could give.
Mm-hmm.
Who's looking to institutionalize their business.
Right. Okay, makes sense. Okay, last question then. For you guys, it sounds like you're not planning on major changes to your strategy going forward. I mean, are you looking at this year? It sounds like you're looking to still grow the business. I mean, maybe you can give us a sense of how you see, the rest of the year playing out for Finitive.
Sure. As I mentioned, we have a very strong pipeline at the moment. We are working very hard to satisfy the clients in that pipeline and put the capital in place that they need to continue funding their operations. We do expect to continue to grow, whether that is measured by capital commitments raised, number of clients, even our headcount. I think we're looking at expanding in the second half of this year. So I wouldn't exactly say it's business as usual. This has been a very unusual time. Mm-hmm. We continue to move forward and execute the business strategy that we've had in place from day one.
Right. Okay. Well, best of luck, John. It was great chatting with you again, and I really appreciate you coming on the show.
Thanks again for having me. We appreciate it.
You bet. See ya. I agree with John there that I actually think 2020 is going to be remembered as the year where there was the culling of the herd in the non-bank lending space. There certainly are, across every asset class, there are companies that are struggling and companies that continue to do okay. Certainly the well-capitalized ones, the ones that have really been able to generate profits, generate cash flow, are going to be in much better shape to weather this storm than those that really are still, cash flow negative and trying to claw their way to profitability. I think those kinds of companies, it's going to be very difficult for them, I think, to survive the next 12 months. And we're going to see, I think, a lot of distressed sales of these platforms, and there'll be some that will just go completely out of business. It's what we're seeing. But I think, like anything, when these things happen, the strong will survive. And I think the industry as a whole will be better for this in the long run. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's episode was sponsored by Lendit Fintech Digital, the new online community for financial services innovators. Today's challenges are extraordinary, with the upheaval affecting all areas of finance. More than ever before, we need to come together as an industry to learn from each other and make sense of this new world. Join Lendit Fintech Digital to connect and learn all year long from your peers and from the fintech experts. Sign up today at digital.lendit.com.